Let's talk about the difference between the intrinsic value of options and the extrinsic value of options. Let's just start off with the definition of the intrinsic value, which is the inherent worth of an option if exercised now, representing the option's profit based on the current price of the underlying asset. This takes out the time component entirely and just zooms in on, if we were exercising right now, what would be the value? So we can look at the formula for the call option's intrinsic value, which is equal to the max of the stock price minus the strike price, or 0. So if we had a call option that we owned with a strike price of 40 on an underlying stock that was priced at 60, that means that we could buy something for $40 that is actually worth $60, and the intrinsic value to that is 60 minus 40, so $20. But how about if it's a put option? So the put option's intrinsic value is equal to the max of the strike price minus the stock price, or 0. So if we kept those same examples, where the strike price is 40 and the stock price is 60, we own this option, we would never sell something for $40 that's actually worth $60, so we would just choose not to exercise this option because that is a value of negative 20. And so we would just take the max of negative 20 or 0, which is 0, because these intrinsic values can never be less than 0. The extrinsic value is really the time component to the value of an option. So the definition of extrinsic value is the additional value of an option above its intrinsic value, which accounts for the possibility of future price movements. Now, if we look at the formula to price options, we can simplify it as the option price is equal to the intrinsic value that we discussed earlier, plus the extrinsic value that has value related to how this option's value could change in the future. Now, let's dive into an example of how we can see how both the intrinsic value and extrinsic value change in an option over time. The top graph represents the stock prices for the largest ETF of the S&P 5 index, known as SPY. And you can see that generally the stock prices had gone up over time in this 6-month period, and that we're going to be looking at a call option with a strike price represented by that orange line of $350. Now we can see that this call option is in the money its entire life because there's no point where the strike price exceeds the stock price. So now if we look at the bottom graph, this is the SPY call value for the call with the strike price of $350 over the same 6-month period of time. On October 3rd of 2022, the furthest left part of this graph, that is when this 6-month call option is issued. You can see at this time, the extrinsic value, or the value coming from the time component of the option, is represented in yellow. And it is actually a large chunk of the option's value. The other component is the orange block, which is the intrinsic value. For any given day, we can find the call price, which is that blue line, represented by the intrinsic value plus the extrinsic value. And then we can see how theta impacts the price of this call option. As the call moves from its original issuance to closer to its maturity, we can see that the extrinsic value continues to decline as that yellow bar just gets smaller and smaller and smaller. And as the option approaches expiration in the furthest right day of the graph, you can see there is virtually no extrinsic value left whatsoever because of the time value decay of the option. Now let's look at a different call option on the same stock SPY for the exact same 6-month period of time, except in this case, this is an out of the money call option because the strike price actually exceeds the stock price for the entire 6 months. Now, if we look at the bottom graph, we can see that the SPY call value is determined entirely by the extrinsic value of this option because there is no intrinsic value if the strike price exceeds the stock price the entire time. So here we can really isolate this extrinsic value and see that it's going to start high in October 3rd of 2022. And then over time, we should see it generally decrease as we get closer to expiration. There are examples where the extrinsic value increases over time. You will see that this is when the stock price gets closer to the strike price. When the stock price is closest to the strike price, that's going to be when this time value, this extrinsic value, is the highest. But one thing you'll notice is that as the option gets very close to expiration, that means the furthest right on the graph, there is virtually no extrinsic value whatsoever, and the call price is near zero. This video is a part of my course, Options Theory to Practice. I'll guide you step by step through the fundamentals of options, all within a safe and controlled paper trading environment where no real money is at risk. You can learn more via the link in the video description or pinned comment.